514 billion is higher than any of the forecasts I had seen.
The best approach there would be greater fiscal discipline, which we're not likely to see.
The real risk is in our Treasury bonds, because the folks that used to buy Treasury bonds, the Fed, China, Japan, no longer buying. You've got debt through the roof. I mean, the leverage risk basically shifted from consumers and corporates to the government.
The U.S. Treasury bond market could be on the brink of a complete collapse. This is a $27 trillion financial asset, roughly the same size as the entire U.S. gross domestic product, and the impact that a collapse of this market would have on the economy would be catastrophic. U.S. Treasury bond prices have already fallen by 50% since 2020, which has already reshaped the entire economy and financial system. But as I'm going to show you in this video, we're potentially at risk of seeing another monstrous move down, which could have even deeper economic consequences. So just for some context, unless you've been living under a rock, you might have heard that the current US administration has torn apart every single long-standing trade partnership with foreign governments around the globe. You probably also know that these same foreign governments are also holders of US Treasury debt. In fact, foreign ownership represents about 30% of the current outstanding US government debt. As they say, the borrower is slave to the lender. What would happen if these foreign holders of US Treasury bonds realize that they don't trust the US government enough to keep holding this debt and that they begin to sell it? Well, the Treasury bond market works just like any other market. It's influenced by supply and demand. If demand outweighs the supply, prices will go up. But if supply outweighs demand, prices will go down. So if foreign entities no longer trust the US government debt, firstly, that reduces demand because they stop buying any new US debt, and it also increases supply because they could sell the Treasury debt that they own. This is what's called foreign dumping. And this theory of foreign dumping has been around for years, but it's never actually happened because the world has trusted the US government. But it's possible that this is changing. We don't have concrete evidence of this happening yet. The most recent data shows that foreign holdings of US Treasury bonds has actually gone up, but that was in February. This was before Liberation Day on April 2nd, where Donald Trump cut ties with major US trade partners. It's very possible that the data will end up showing that April 2025 was a major turning point for foreign holdings of US Treasuries. But this actually isn't the main reason why we are concerned about the Treasury bond market today. Foreign dumping of Treasuries is just the tip of the iceberg that is being covered by media. As is often the case with financial markets, the real forces driving assets are happening underneath the surface and are much, much more powerful. One of these forces is the massive level of the government deficit that we have today. Since the 2008 financial crisis, the federal government has been running at least a $500 billion deficit. Since the pandemic, it's been running at least a $1 trillion per year deficit. This is the difference between what the government earns through taxes and what it spends. Clearly, it's spending much more than it earns, and no, this is not a problem that is being resolved by the current administration, as the deficit for 2025 is projected to stand at about $1.9 trillion. And this is projected to get even worse in the coming years due to many structural forces pushing to higher government spending. Now, how does the government spend much more than it earns? Well, it needs to borrow money in order to finance this deficit. And when the government borrows money, it issues treasury bonds to US private investors, institutional investors, banks, foreign private investors, and foreign governments. So, in other words, the US government has been issuing a record amount of US Treasury bonds over the last 5 years and is projected to continue doing so. So, massively increasing the supply of US Treasuries. As we mentioned earlier, the price of Treasury bonds is determined by supply and demand. A massive oversupply of Treasuries will push down their prices. But there's another factor at play that will significantly increase the supply of Treasury bonds. And that can be seen on this chart right here that shows us the amount of government debt that comes due each year. In 2025, about $7 trillion worth of government debt will be coming due. This is what you call a maturity wall. And the only way the government will be able to pay back this $7 trillion is by doing what's called a refinancing, which basically means that the US government borrows more debt in order to pay back the debt that's coming due this year. So in 2025, a record deficit and a massive maturity wall will be flooding the market with a huge supply of new treasury bonds, which could put significant downwards pressure on prices. But now you might be wondering just how much downwards pressure on price are we talking about here? Because after all, US Treasury bond prices have already been the worst performing asset over the last 5 years, plummeting by about 50% since 2020. How do we know that Treasury bonds are not already taking into account all of these concerns? In order to answer that question, we can't just look at the supply of Treasury bonds, we also have to look at the demand for them. Treasury bonds are an investment like any other. The demand for them depends on whether investors feel like they have an attractive investment or not. And that essentially depends on whether the return on investment on Treasury bonds is high enough to compensate for the risk of owning these investments. And right now, that is certainly not the case for US Treasury bonds. We can see that by looking at something called the term premium of Treasury bonds. This essentially reflects the extra return on investment that investors are getting for holding long duration bonds like the 10, 20, or 30-year Treasury bond. And the term premium has a big impact on the total yield that investors are getting for holding long duration bonds, as you can see by this line here. Now, this might sound quite technical and complicated, but it's really not. A high term premium means that investors think bonds are risky, and so they're asking for a higher yield to own them. A low term premium means investors don't believe these longer duration bonds are risky, and so they don't ask for a very high yield. Now, throughout history, the term premium has generally stayed between 1 and 2%, which has kept Treasury bond yields at quite high levels throughout the last 60 years. Today, the term premium on long duration bonds stands at about 0%, which means that holders of US Treasury bonds are not being compensated for the risk of holding them. We think that we would at least need to see a term premium of about 1.5%, which is the average of the last 50 years of data, to say that Treasury bonds actually reflect all of the risks that we talked about in this video. That kind of jump in the term premium could push bond yields from 4.8% today all the way up to 6%. And that would be absolutely devastating for Treasury bond prices. Because when Treasury bond yields rise, that's accompanied by a proportional decline in Treasury bond prices. A move up of Treasury yields from 4.8% to 6% could lead to as much as a 25 to 30% move down in Treasury bond prices. And this would have potentially devastating consequences for the economy and the rest of financial markets. Government bond yields are a benchmark for all other yields around the economy. A higher US Treasury yield will mean higher cost of borrowing for businesses, because corporate bond yields will also go up, and that will slow the economy down. Higher Treasury yield would also mean higher mortgage rates, which would further reduce access to housing that is already extremely unaffordable today. All of this would significantly increase the odds of a recession happening in the United States. So we very much hope that we're wrong about our pessimism on the Treasury bond market, because if these things happen, it would cause a great deal of pain. But the truth is, there's a real possibility of this happening. Make sure to like and share this video so people are aware of what is happening and can prepare themselves accordingly. Thank you.